Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining us. I'm your host, Lance Pederson. This is the Real Estate Risk Report. So today I have Brian Adams with Excelsior Capital with me. How you doing today, Brian?
I'm doing great, Lance. How are you?
Yeah, doing really good. So we're
Good.
in the midst of a bit of a snowstorm here up in Portland, which is an unusual thing. So where are you located?
Nashville, Tennessee, and it is equally unusually like cold for here, for anywhere, frankly. It's just for this part of the world, people are losing their minds. So it's like below 30 and it's going to stay that way for a while. So in this part of the world, that's the time to buy toilet paper and bottled water.
Yeah, I hear you. It's probably the same in Portland. I was like, I probably should, once we get done with this show and wrap it. So this is, we're here just before Valentine's Day in February for those. So this won't air for a little bit beyond that, but yeah, so definitely we're about the same. I think we've got 27 degrees here today. So it is kind of unusual to have Nashville and Portland, registering a similar temperature, at least, especially in the winter. So, well, while we get into it here, why don't you go ahead and just give us a little bit of background into how, I kind of call it the origin story, but, how did you get into, real estate investing and ultimately, just curious what led to the formation of deciding to form Excelsior Capital.
Yeah. So I'm from upstate New York originally. I went to college in Connecticut, a small liberal arts school there, where I met my wife, who is from Nashville. So we did the Northeast thing for a little bit. I went to law school in Boston and then moved to Nashville about 15 years ago now. And my wife's family has a single family office, which has invested in the commercial real estate space for the last 25, 35 years. Generally as an LP or maybe a co-GP in some limited circumstances. They also did some direct co-investment alongside some of the GPs they invested in through a fund. So when I joined the family as an ex officio board member, I got exposure to the investments we were making and the sponsors and the general partners we were working with, and just caught the entrepreneurial bug. I thought real estate was a great business. I didn't really want to be a lawyer long-term. It seemed like not a lot of fun. So I was able to connect with my business partner, who is also a New Yorker, who married a Nashville girl. And we started our business 10 years ago, initially just raising small blind pool commingled funds, which we can get into if you want, but I think not really the right optimal vehicle for individuals and families to invest into real estate with. But we did the fun thing for a little bit. And then about 5-6 years ago, we started offering up direct co-investment rights to our fund LPs. And that's when the business really scaled pretty dramatically. They would bring in their friends and their families, and they loved the direct deals. And that's when we realized that we were in the wrong business, and we pivoted towards a direct deal by deal syndication model. So at this point, we've got around 2.5 million square feet under management. It's probably around $400 million of real estate value. And we're in 12 markets across the Southeast and the Midwest. And the genesis of Excelsior, which is kind of the second iteration of my real estate entrepreneurial journey, was we built a portfolio over time. We recapitalized it with some institutional investors, but I made a bunch of mistakes the first time around. I continue to make mistakes, but I made some big ones the first time around. And Excelsior was my effort to have kind of a 2.0 restart and not repeat those same mistakes and really try to optimize all the lessons I had learned over the last 11 years now.
Yeah, no, it definitely has been investing in general, whether it's real estate or stock market or, it's like anything in life, I guess, right? It's like you're going to learn through trial and error. I mean, that's what, fundamentally it's what learning is. Now, I think, like you said, the entrepreneurial bug, and certainly like my whole life, didn't know when I was younger, right? But I'm an entrepreneur, right? What does that mean? That means that you're a little bit more comfortable screwing stuff up, like almost intentional, right? Like, let me try this, see what happens. Oh, that hurt, okay, next, do it again. And, of course, the thing, it's like gambling or investing, it's money, right? So you don't, you want to figure it out pretty quick. right? And I think it's why we do this show. It's the more that you can learn, because clearly you've got a couple ways to go. You make all the mistakes on your own in a vacuum, which will be costly, or you listen to other people that are smart and have stubbed their toe a time or two and learn from those mistakes. And it's
Yeah.
interesting, even bring that up. I find that, and I understand it from most guests' standpoint, right? It's not that they're not willing to talk about it, but it's like that there's scars there often, right? Like it's not fun to talk about, the times that we, kind of screwed things up and made mistakes, but there's valuable lessons to be learned there. So that's kind of one of the premises of the show. So with that said, I mean, for you guys now that you've, tried some things and learned some things, let's dig into that a little bit about, you mentioned the commingled funds, from 10 years ago versus the direct. So maybe give us some color on why you're not as bullish on sort of the commingled fund sort of thing. Is it just because they're not as marketable and harder to raise money into, or do you have some other underlying, philosophical way of looking at it now that you didn't back then?
Yeah, the marketability of the product is certainly a big issue. I just think, especially as a first-time fund manager or an entrepreneur, if you haven't come out of the fund world and you don't have attribution towards a track record of a previous fund that you were a member of or a partner of, and you're not part of that kind of Wall Street fund ecosystem, it's just hard to go out there and raise a blind pool fund and say, hey, this is my plan, right? I mean, I think that's just a challenging product to pitch to people and a hard story to sell. So that's certainly part of it. But the other one is, I see this issue amongst GPs and sponsors where they want to have this kind of this golden goose key that will unlock all of the secrets of the universe, which is discretionary capital, and that will lead them to glory. And the reality is, I think there's a lot of lessons to be learned by going out there and getting the no's, raising capital the hard way, trying to get the warm introduction, the referral, trying to get in front of somebody for 5 or 10 years, and then finally getting them to build that relationship with you. It's what I've learned, and this took me a while to really embrace, but it's supposed to be hard. There's not supposed to be an easy solution there. And I really like the fact that as a sponsored GP with my network of investors, when I show them a deal, I need to make sure that everything is squared away, because they will poke holes in it. They will ask hard questions. They will do their own underwriting. They will talk to their own, local professionals in whatever market that I'm transacting in. And it better stand up to their scrutiny. And I like that because it makes me a better sponsor and manager. And, frankly, when I was raising the funds, it did fine. But what I really discovered was that a lot of these individuals and families had access to a Blackstone fund of funds, or, obviously REITs, or maybe other synthetic ways to get real estate exposure. But what they really wanted was direct access without the headache and the heartburn associated with finding the deal, running the deal, taking on the guarantee risk, et cetera. So once I shifted the paradigm between just pitching ideas that I thought were great and kind of cramming it, and I pivoted towards a more empathetic sales approach of solving the problem in my investor base, and that was direct access to deals that gave them double-digit cash-on-cash yield, it just allowed me to scale the business much more efficiently.
Yeah, no, I completely agree. And I think that with our kind of sister company, Fairway America, similar journey, right? Like it's not just, and I think you hit on it too, just that holy grail of discretion is a bit of a misnomer. I think there are some strategies where, you can kind of pull that off. I think, the one that, kind of our roots, that we were able to pivot into, was kind of these, debt funds, especially if it's unlevered with all high net worth investor capital. So as an originator of loans and making underwriting decisions on loans, it is, especially since, oftentimes the loan amounts relative to anything else are smaller, and being able just to make those decisions and construct a portfolio, it makes a lot of sense. right? And you can kind of have what you'll call discretion. I think that, as you know, our firm, private equity real estate firm, Fairway America, you know, has evolved and matured. I think we've realized the same thing, is that, you know, yes, we have discretionary funds. They are harder to raise money into. They do solve a problem for certain people, right? It's nice to get diverse exposure with one investment to many things. That's great. They're a ton of work administratively, especially if they're evergreen or open-ended. And but really, yeah, and you have some amount of discretion, but fundamentally, the you know, there's all these parties that are working together to make a deal a reality, you know, whether it's the lenders in senior position, or even, you know, it's like the sponsors, and all this negotiation, all these things that have to take place. It really, you know, it's the notion that you can just go and use, you know, raise money, like you said, into just some vehicle and then go do whatever you want to do. It is just a complete fallacy. In fact, being kind of spend a lot of my time doing fund advisory work with people that come to me. That's what they say. I want a $500 million fund that I can just go buy whatever I want when I want it. The money will just be there. And I'm like, well, you know, join the club, you know, we all would love to have that, right? Like, that's not a thing. It doesn't happen. Maybe, you know, it just doesn't, because you're always served some master. Because even the big boys, like you said, Blackstone or whatever, you know, whatever, it's like, even for them, I mean, where's the money coming from? It's coming from pension funds, endowments. It's coming from somewhere else. Like, you know, everyone's got a say in this thing.
And
you know,
and I think that's part of the miscalculation is, you know, the fund is a great solution for big institutional LPs that are non-taxable, that they want to write a $25 million check. They want automatic diversity, and they're filling an asset allocation that their OCIO or advisor is telling they need to fill. A fund is a great vehicle for that. But the problem comes in when sponsors or you know, aspiring GPs say, man, I really want to do a deal with Blackstone. And my initial pushback is always, well, why? I mean, these guys are going to rip off your face on fees. They're going to tell you exactly what to do. They're going to have, you know, control rights, and it's going to be a really difficult deal to pull off with them. And you've got to remember, as a sponsor who's talented, right? If you're an operator, good at what you do, there is no incentive in the world for Blackstone or Carlyle or these big boy private equity institutional funds to ever allow you to raise your own discretionary capital fund, because you're just competition.
Yeah.
So everything they do economically and legally from a structural standpoint is going to make sure that you can never take their LPs away from them.
Yes, that's exactly right. That's exactly right. And it's just, that's why it's like, you know, put it out of your mind. And what seems to be, you know, easy, and that's sort of this mirage. It like seems like, well, if I can just get one and they can write a 20, 50, $100 million check, then problem solved. No, they do. They rip your face off in fees. You can barely, I mean, it doesn't pencil. If it just doesn't, like, it's so lean. It's like, you can't, you know, there's not enough there. And, you know, it just doesn't make any sense. You're far better off building a base of, you know, high net worth investors and family offices and those sorts of things, not to mention more rewarding.
They have an army of Harvard Business School guys, and they have buckets of capital. They don't do stupid deals.
No, they're going to protect themselves every which way from Sunday. You know, like, it's just, that's how it goes. In fact, I'm doing a talk at the Best Ever conference next week, and it's on this, you know, institutional capital demystified. So it's very appropriate.
Yeah.
But yeah, and I think it's important. It's an important topic. I think it's important for all the participants, you know, so even the passive investors, to understand where you fit. Because I think what I hear a lot of times from even those investors, they and I can understand it, is they feel like they're sort of like, they're insignificant. Right. Well, I'm only investing 25 grand or 50 grand or whatever, you know, like it's he who has the gold makes the rules. They don't feel like that's enough gold to make any rules. But the beauty of it is that it is symbiotic, and understanding that as an LP, even if you're just, you know, just completely passive or whatever, you know, you do have say, and that's not licensed to go and like try to get super involved, because that'll annoy the crap out of any operator or sponsor. They're going to basically say, you know, you can keep your money. I don't want it. So that's certainly going to be the case, but it really is the best match at this lower level, right? Of like middle market real estate or whatever, these non-institutional transactions. It really is the appropriate fit. And that's the beauty of what's happening right now, is that the amount of access points that exist now for passive investors is just increasing by the day. And I think and it's awareness of the private markets and, and the ability to get into stuff. So it's an exciting time to be a part of it. So with you guys then, like, so, hey, you got this, you realized, hey, the fund, not, great for certain things, not here. You make the transition to, hey, we identify a project that's worth investing in, you get all of those things tied down. How are you usually going in with your group? Because I'm assuming you're not always the operator. Like sometimes you're just serving, you're partnering up with someone who's doing the operations, or you're always the operator.
We're the operator sponsor. Yeah. So we source the deal, we raise the capital, we run the deal.
Got it. Yeah. So you're doing the full thing. So for you then, when you structure these, it's always syndicated, or like, do you ever partner like in a 90-10, kind of joint venture deal? Do you do any of that, or do you just syndicate like everything?
Yeah, it's a good question. We certainly have in the past done what I would refer to as separately managed account co-GP relationships with.
Yeah.
We've done 3. One was a group out of Tel Aviv, Israel. We did a number of deals with. Then they wanted to be, 95% plus of the equity, but they wanted a domestic sponsor for all kinds of reasons.
Mm-hmm.
The same with a family office out of Oklahoma City. They wanted to deploy X amount of capital, but they didn't want to be the operator. So we structured a deal with them. And the same with a large RIA multifamily office out of Atlanta. We did a similar structure with. So it can work. It does work. I've learned that you need to be really transparent on the front end about what the objectives are. And oftentimes we actually don't syndicate those deals to our LPs, because what you get, and justifiably so, is those folks want to have control rights, oversight rights, major decision-making rights, et cetera, which makes all the sense in the world if they're going to be in the majority equity. But if you bring in your own LPs to those deals, you need to fully disclose what the relationship is, and you need them understand that they're going to be a Class B investor or a Class B shareholder in those type of structures. And oftentimes it's not the right fit. So we will do them, but our bread and butter is just syndicating deal by deal to our network.
Got it. And then in terms of like the types of stuff that you guys are you any property types in particular that you focus on, or what? So I guess give me a little sense of kind of your own investment mandate. Like, what are you out looking for?
Yeah.
Property types, maybe markets, that kind of stuff.
Yeah. We've really simplified things where we don't do the resume pitch. We don't talk about how great we are and where we all went to school and all that. We talk about the problems we solve, right? So we do 3 things: give people access to real assets, solve for a double-digit cash-on-cash yield annualized that we distribute monthly, and we do everything we can to accentuate the benefits that come from direct real estate ownership.
Mm-hmm.
Now, what that product and service looks like is today commercial real estate, and that could be anything from office to medical to flex to industrial, but we don't do any residential as of today. And historically, it's been a lot of suburban office and secondary markets. And again, it goes back to solving for that double-digit yield, because without taking too much risk or leverage, we're cap rate driven, right? So we have to go where we can find value. And that's led us to secondary markets. So think of places like Kansas City, Cincinnati, Richmond, Virginia. We're doing something in suburban Detroit right now. We're looking at a deal in Chattanooga. So those are the type of markets that we go to, but it all comes back to solving those 3 problems that our investor base has.
Well, it's interesting, because correct me if I'm wrong, but right now solving for a double-digit cash-on-cash return is really, really hard. Is it not? Like much harder than it has been?
Yeah, we do hard things, Lance, but yes, it is hard. We've had to go down market. So historically we were $15 to $20 million acquisition. Now we're focused on $10 million acquisition, and we're able to find these opportunities, but they are far and few between. And the appetite level is very strong. So one of the dynamics we're dealing with is how to manage an oversubscription process, because there's just not enough to go around. And we were able to find some things north of 12% cash on cash that are stabilized and good products. But it's hard to, you have to be realistic with the amount of capital you can deploy to that space without suffering from style drift and management drift. So I think realistically we can do 4 or 5 of those a year if we work really hard. But given everything going on right now with the amount of liquidity in the market and the amount of just appetite for yield, cap rate compression is real. And I tell people all the time, they don't believe me, but suburban office, you can think what you want. I see the deals. Cap rates have gone down dramatically since COVID. If it's a good deal, it gets bid up. And I don't think that dynamic is going to change anytime soon.
Yeah, exactly. So what it has been, I guess, pre-COVID, maybe give me a thumbnail sketch of sort of like a bread and butter deal that would solve for that double-digit return.
Yeah, so I can talk about one that we're working on right now in suburban Detroit. It's in the Birmingham submarket, which is, call it 10, 20 miles outside of downtown. Good, healthy, affluent area. It's a $10 million acquisition. We're buying it at, just south of an 8 cap, 100% occupied, good weighted average lease term, call it north of 5 years. And it's single story flex industrial. So it's kind of that product type that you see around airports, where this is not to, bring levity, because what we do is serious, but it's kind of the mullet of commercial real estate. It's kind of business in the front, office, retail,
Totally.
and then industrial distribution in the back, right?
Yep.
And right now with COVID, tenants love it because it's cheaper leasing, and everyone has their own individual ingress egress bays. So there's really no common area. They have their own specific bathrooms. They don't have to interact with anybody else. Clients can go kind of easily in and out. And it's a mix between medical. There's a dialysis clinic there. There's a garage, kind of educational company there that's backed by Ford, as well as more traditional kind of what you would think of as a flex user. So probably not the prettiest building in the world, but I think year one, it's 14% cash on cash, and the average is 12 across 10 years, and a very tight submarket where on a triple net basis, we feel really good about being able to continue to incrementally push NOI. And we have something similar in Chattanooga, but those are the kind of profile that we're focused on right now.
So for you guys then on the acquisition side, like trying to source that, because and it's interesting. I love how you sort of, this is what we are, right? So it's sort of like a forcing function, right? Of like, you got to solve for these things. And so I tell you all the time, like that's how the savvy investor, I call it conviction. It's like, this is what we're doing. We're sticking to it, right? And then that drives all the other decisions, right? So those are the constants in yours. But to your point, it forces you, as the market does what the market does, to have to sort of, you got to go look for it someplace else, right? So how did you deal with that, right? Because like a lot of people, it's pretty, I think real estate's location, location, location. You have to be local. You live in this place. You buy stuff that's near your thing. I mean, that's sort of how most people do it. In your case, you've got to go much further afield. I mean, you got to go outside of, it's not Nashville. You might live in Nashville, but that's not where you transact. So how do you develop and build those relationships when you're all over the place like that?
Yeah. And to dovetail to our earlier conversation, this is exactly the environment where being a fund manager is hard, because you are married to that PPM. And if that PPM says that you're going to deploy capital to this product type in these geographies at these various LTV scenarios, et cetera, you cannot go outside of that unless you go to your LPs and get an exemption. And by the time you do that, the deals might be gone, right? So I love being nimble as a fundless sponsor. But to answer your question, what we've seen, which is really interesting, and not a lot of people talk about it, over the last 10 years since I've been in this business, these brokerage firms, like Cushman, CBRE, JLL, Avis and Young, they've all become institutionalized, and they're all now publicly traded companies that have shareholders that are asking them to get quarter by quarter, revenue generation. And so what's happened is these capital markets groups, these sales, these guys, mostly white 50, 60-year-old brokers that used to sell product in Columbus, Ohio, Kansas City, suburban Detroit, they're being told, hey, you need to relocate to whatever the major metro is for your region, or you're out of a job. And so oftentimes what we've done is using leasing brokerage connections and these kind of older capital markets guys that they're probably on these bigger teams now, but they still have relationships with these landlords and owners of these smaller product types, is just go to them directly. And, after doing this for 10 years and after transacting at $400 million in these submarkets, brokers would rather get paid their 3 points than go on a long kind of 6 to 9 month marketing process where they might get retraded and they might not transact at all. So we have a good reputation. We have great seller references and we have great broker references. And once you transact as a gentleman, you start getting calls, right? And so for us, we have a CRM and we say, hey, in the next 6 months, we're hoping to deploy 20 million. And these are the product types that we want. These are the cap rates we want. This is what we're solving for on a yield basis. Bring us product. And, if you think about it as a sale, if you think about it as an operator that you're selling your company as a liquidity option for current owners and a way for brokers to get paid, you'll get product type. And that's the biggest misconception, I think, is younger people come to me and they say, oh, I want to be on the buy side. I want to be a principal. And I said, listen, I'm on the sell side every day. I'm either raising capital or I'm selling myself to a brokerage or an owner for them to transact with me. So you've got to change your mindset 180 degrees. Otherwise, I think it's going to be very difficult for you to be successful in this business.
Yeah, I agree. And I think it just episode after episode after episode that we do this with is that it just can't be emphasized enough how valuable relationship building is, meaning like it is the relationships. And I think that, like you said, it's weird that how many participants that are in the business lose sight of that. Because that's basically what it is that, and for me, I like bringing up the fun thing too. Cause I mean, at our heart, we're fund administrators, right? So this is the odd thing. I help people architect funds, but for years, I've been basically trying to talk everybody out of it. Like for the reasons you just said, right? I'm like, you got to make sure that there's a good reason, a good fit to start a fund. Right. And then the same things of like, so it just seems that people want to do things because of what how it makes them feel. The mystique of being a fund manager or being an investor on the, like you said, on the buy side, it's their reason and motivation or why they're doing what they're doing is misplaced. Right. And like you said, it's like, once you flip and say, no, I'm on the sell side every day. I've got to go and show and prove to these guys that we're worthy. That's how I tap in to the transactions. Right. And you overlook that, you're sitting there, you got nothing to buy, or now you feel the pressure to have to go and transact just to transact to get your acquisition fee. That's all the misalignment that we hear about.
Yeah. There's this endemic hero complex issue in our business that's super ego driven about AUM and these milestones and how you present yourself into this ecosystem world. And frankly, I think it's totally misaligned. And after doing this for 10 years, the numbers are so relative. Like, I don't care what your AUM is because some other group has 200x that, but it doesn't mean that they're any better or worse than you. What I love about the business that I have today is I've got a great niche, I've got a great investor base, I've got a good team. We know what we're doing. We have a high conviction of what we're doing. And the fact that we can't scale it out to be $1 billion platform in the next 2 years, I'm totally good with that, because I think most managers that seek that type of AUM, the returns are almost inversely correlated oftentimes.
Yeah, I agree. I mean, it's like it's almost like you have to sort of you got to pick a lane, right? You're either going to be, go and build a gigantic portfolio, sell yourself out for that. Once again, some people are wired like they enjoy that, like that's their idea of a good time, is just transacting and building all these these big numbers, right? But to your point, like what you're working for is all relative. Like you could be doing the same thing, but the amount that spits out the other end in your pocket isn't all that much different. If once again, it's probably less, not to mention the returns that are going to the end, whoever that end investor is, that pensioner, whatever, I don't even know where the hell it goes. Right. But then on the other side, when you go back the other way, it seems to me, it's so much more rewarding. To your point, just like you said, you're doing what you like, you have high quality relationships, across the board, right? You're making a difference, not to mention you're getting more, there's more, you're getting more juice off your squeeze. I think it's just how it goes, right? Because there's not so many people in the middle of it, right? Like you're finding the stuff, you're running your own deals, you're the operator, investor can go right into it, get direct access. You can be compensated for the effort. Once again, even though it's a smaller dollar amount, and the investors get, what can be a really great risk adjusted return. That's mean, it's not rocket science. It's like what Dell did with computers in the 90s, right? They're like, how do computers get sold, right? Like they go through all the, they go through traditional just distribution channel, a network, right? So all these hands that are touching it, and that causes the price of the computers to be more expensive at the end. Like it's not, this has been going on forever, right? Well, they said, well, why don't we just sell them directly? Well, that means that they get more. The consumer wins, they get a cheaper computer, right? And Dell gets to keep more, right? It's genius. And I think that that's what the Jobs Act did for us, is the ability to just talk more freely about these things, as you and I are right now, and not have to hide how we do what we do. And then the fact that the everyman, or at least those who've attained sort of accredited status at minimum, to get access to these sorts of opportunities, it's the Dell direct model. I meet someone like Brian who has conviction and has a strategy and does what he does to add value, and I can invest into it passively and get what I want, income, solve for income in my portfolio. It's a beautiful thing. Like you said, it's not about the big numbers. It's just about, is it solving, do you get to do what you love doing and make money and be compensated for it? And does the investor get what they need? Can they have financial freedom? Yes. The answer is yes to all the above.
Yeah. Disintermediating this Wall Street complex, where the only other way you could access this stuff is through like this access fund into a fund of funds, Blackstone vehicle, or these REITs, which are synthetic representations of direct real estate that are correlated to the market. It's crazy the way it ran for the last 25, 50 years. But now with technology, I mean, God, meeting somebody on LinkedIn, having a Zoom with them, and then understanding that you could solve part of their problem and being able to have them access a deal in Chattanooga if they live in Portland, it's unreal how powerful it is. And, it's a lot of fun to be a part of it, frankly.
Yeah. And I agree with you, Brian. I mean, that's what gets me up in the morning, is to be a part. I think I listed on my LinkedIn profile, right? Like, I just want to do my part to help the ecosystem operate more efficiently, right? So that's how I see it, right? Like, how can we remove friction from what you and I just talked about, right? Because I mean, we're not there yet. I mean, like it's the doors are open and it's possible and all those things, but it can be better, right? We can remove more friction and make it easier, and in particular for me, it's it's all great about Chattanooga, you're here, whatever, and all this stuff. But the issue is I always call it, trust is the transaction, right? When I just met you, I don't know you, right? Well, I mean, there's a problem. What is my process from going to, I just met you, to trusting you, right? With my money that I worked my butt off to get, right? To then get access to something that will solve one of my problems. Well, unfortunately, there haven't been many great solutions for that, right? And most of the people use time. I meet you today, I'll wait a year and watch and make sure you don't show up in the newspapers, right? As to defrauding people. And then I'll decide to invest, right? Yeah. It's sort of like the double Dutch jump rope, where they just sit there like, oh, okay, I got to jump in here. And, an hour later, they still haven't tried, right? And so just removing that friction, like how can we shortcut that time to trust? Okay, background checks. These guys aren't bad dudes. These are good dudes that kept their nose clean, right? What's the track record that they're reporting? Because that's the thing. Like you said, it's like guys like you don't care. It's like it's irrelevant. But there's other guys who are taking advantage of it and saying, I've done, $1 billion worth of transactions when they've done 25 million, right? And they prey on those things. And that's sort of what can give the industry, and does, a black eye, right now. And that's that maturation. That's the next steps that need to be taken, right? To sort of clean those things up. Because to me, it's what the good guys need to win. The people that are worthy, of the money, to be good stewards of the money, the capital should flow into them, right? And especially, it's been this crazy bull run and all this money thrown around and everyone did it. But as you know, and you've been around long enough, like we're going down the other way, right? And there's going to be, it's not going to be pretty. I don't know how bad it's going to be. It could be really bad or could not be hardly bad, but it's a cycle. It's real estate. It cycles. And, so how about you, like with your investors, I mean, kind of the beauty of it for you is like, you've got these built-in constraints where it's like, hey man, it's hard to find a deal, right, that meets the criteria. But as new people, like especially now, I'm going to say, hey, Brian's great. They hear Brian and they reach out to you. How do you balance that expectation though, right now that you don't have a fund or there's not something they could invest in, or like you said, handling the oversubscription process? How do you balance that when everyone wants what you have?
Yeah, and it was a real challenge on this Detroit deal. We were 2.5x oversubscribed, and it was, call it $3.5 million in a week. I'd never experienced anything like it in 10 years of syndicating deals.
Yeah.
But so I think to use Brene Brown, clear is kind. And as long as you're being super transparent with your process and you're communicating that effectively, no one's going to begrudge you how that process is run, as long as there is one. I think where people get into trouble is it's the Wild West, and oh yeah, Uncle Bob gets a full allocation, and sorry, Steve, like you're out of luck on this one. And so what we do is we give our legacy investors, anyone who's invested with us in the past, they get a first look at it for a period of time. And then we open it up to everybody else. And then it's just kind of first come, first served as people kind of sign those documents. And what's been cool with COVID is, and I'm sure a lot of companies and sponsors would echo this, kind of forced us to do some things that we were saying, oh, we should do this, but we're busy running around. So now when people get one of our pitches, we have a drone footage with the pitch overlaid and subtitled, full diligence package, the deck, the model. We do a webinar that's a live Q&A that we record that people can then access whenever they want. And so it's much more efficient, and it allows people to make that decision in a compressed timeline. Whereas before it was, hey, here's a couple of things, let's do a call and we can go from there. We do an FAQ, we do a pros and cons. So we try to give everybody as much information as we can. So it's more binary. It's like, hey, I like this deal. And I want to pencil in X. Okay, great. Then we can set up a call. Or nah, you've showed me everything. I don't even need to hear the call. This is not my cup of tea. I'm out, which is fine.
Yeah.
And that process has really helped, I think, enable us to be more efficient with both our time and our investors' time, because our investors are all professionals. They're busy as well.
Mm-hmm.
And now DocuSign and Juniper Square and everything that we can use from a technological standpoint to kind of decrease those barriers and frictions. It's been pretty remarkable, frankly, over the last 9 months.
Yeah, that's cool. So what is, at the beginning, I think we talked about, some of the learning lessons or stub toes. You got any, what's like the one investment decision you made you wish you could have taken back?
We don't have enough time for all the mistakes, but I think a big one, and to your point, I applaud you for educating investors. One thing that I would definitely point out that a big mistake I made the first iteration of my business was not understanding that as a sponsor and an operator, the real estate deals had to work. But even more so, you are also a small business owner, right? So you've got reporting, marketing, HR, accounting, tax, audit, all of these things that are almost irrelevant to whatever product type that you're investing in, but they are essential to make sure that that investment will be productive and that will work. And so what I tell a lot of investors is you should ask a lot of questions about the deal as much as you want, but you should also ask questions about what the infrastructure in place is for the company itself. Because to your point, I think there's a lot of sponsors running around out there that this isn't their full-time job. They find a deal, they send it out to a bunch of people, but they don't really have an internal operations or procedure in place to manage that deal effectively. And I don't care how great that deal is.
Yeah.
If you don't get K1s out in a timely fashion, if your reporting sucks, if you don't have good asset management, the deal's going to fall apart and your investors are not going to be happy. So I talk a lot about the investor experience. What does that look like? And it was a big mistake I made early on, not putting enough resources into it. And now it's what we lead with. We're so proud of what we build that we think it's an institutional level reporting and experience for our investors. In addition to, obviously, we think the deals are good too. But that's one thing that I think a big mistake I made and not enough people ask enough questions about.
Yeah, I agree. I didn't pay him to say that, people. So,
I mean,
yeah, no,
it's true though. I mean,
it is true, but being a guy who tries to convince sponsors that the reporting is way more important than they realize, that that getting, you can't get a K1 out if you don't have financials, right? If you don't have any of these things in place, it's tough because that's not what's on their mind. It's like, I want to transact, I want to do deals. I mean, I'm painting a broad brush here, but it's like, and that's where, for me, it's saying, okay, It is hard because, as you know, you're on the reboot, right? So you kind of learn the hard way. My thing is like, well, we just need to make it turnkey, because frankly, that is part of the issue. Because even when you can get the right, you can get an asset management fee that's not crammed down, all that. When you take all the revenue streams that come in, it's really light. I mean, they're still going to make your money if you're successful, and that's at the end. You can't spend the money you might get 5 years from now today, right? And so to me, that's why I say removing some of the friction is, let's just give them turnkey service. So that's my whole thing. Like, if you want to syndicate and you're good at finding deals and you know how to do some asset management, then if we can plug in as much of this administrative stuff, so it's not just software, it's software and humans and whatever, and it's variable expense, that makes more sense, right? To me, right? But trying to sometimes get through to them that, and as you've learned, right, it's that even it's those things that you want to do it. It's easy to say out loud. Yes, that's right. I want to strive to, I want to have better reporting. I want to do all these things. But the problem is that requires you to go and recruit humans, figure out hiring, which once again, that the success rate of most hires is, I mean, it's proven, like scientific, it's like 2 out of 10. It's not great, right? Like, I mean, most people are failed hires. You didn't get the right person. People don't want to admit that. Now you got to manage that person. Well, most real estate related guys I've met aren't world's beaters in the people management department. They're not really interested in managing and developing talent. Certainly someone who's does something that they know nothing about, like accounting or whatever. Right. But it's like, it's not an excuse. You can't make an excuse for it. Right. You can't sit there and continue to perpetuate and not take it seriously. It makes or breaks, like you said, the deal, because everyone will go, they're so upset that they never reinvest in you again. And finding another investor is costly, and it's your reputation. So
yeah, I mean, it's the infrastructure, my controller is a CPA with a public accounting tax background. He's really good. We're going to get K1s out next week.
Yeah.
The guy ain't cheap, right? And I've got to make sure that I incentivize him to stick around. You've got that plus Juniper Square, which is terrific. It's not cheap. Mm-hmm. It's a lot. It's not like you can just go out and be a deal guy. And when I tell, and it's maybe an imperfect, allegory, but you can go and be a cowboy in the Wild West, but their lifespans are short.
Yeah, they are. Yeah. And that's those things have to come, and it is a steep barrier. I mean, as evident. And that's why I think it's important to point out, like you said, because the translation is that, hey, you're an investor, you're listening to this, is that conducting what amounts to operational due diligence. That's what it is. It's not just about, hey, these good guys got good strategy, whatever. That's why I say it's who are the service providers? Who is the team? Who are the people, right? But then also understanding that when the same time you're cramming them down and giving them a hard time about their asset management fee or the acquisition fee, I'm saying pull out Excel or your calculator or whatever you got and plug in what those dollar amounts are, right? And then look at a pro forma of the opcos, revenues. It's not that much money, right? Especially like you said, when you're having to go down and they're $10 million acquisitions, those are tiny. That's tiny transactions in the grand scheme of things. And so, the percentages don't really work in your favor, right? And so there's not enough to go around. That is one of the problems. And the way to clean it up is, I mean, for me, I'm an entrepreneur. So I look at it like, it can't be that hard, because if it's that hard, it doesn't work. It needs to be easier, right? It's just like doing a high-tech startup in 98. You had to go and like buy servers and hire IT guys and engineers and all this crazy stuff. The barrier to entry was high. The capital costs were high, right? But then Amazon came around and said, we'll just sell you compute power. We'll just give you a platform. Well, now all of a sudden you could just start one in your dorm room. If you could code, you're in business. Right. And so I think that that's the next evolution in this industry. It was certainly the thing that I'm passionate about, but it's like, there's no excuse for not doing it. It cannot continue to be a differentiator for indefinitely, right? That's good for guys like you. You can use it as a differentiator, but it's not good for the industry. Like, it's a table stake. Getting K1s out on time and reporting consistently. Come on. Like, it's the expectation.
It's indefensible nowadays to not have institutional level reporting and marketing and investor relations.
Yeah. And it's because that's what makes it happen. Because that's the thing that will keep investors out of this, is they're just like, man, it's too nerve-wracking, right, to not have those things in place. But it's, for now, that's why I say
the guys who figured it out and have built those systems and have really, made it a point of something, the emphasis to deliver it and execute on it, that's what puts pressure on everyone else. I mean, that's what I'm a believer in. Like, you can lead a horse to water, you can't force him to drink. When other people are out there doing it and executing it, then they say, how do I raise more money, or how do I do whatever? It's like, figure that out, solve that problem.
You don't get 2x oversubscribed just because the deal's great. It's because people want to allocate more and more, and your conversion rate amongst your current investors, it's all about customer acquisition costs, both time and money, right? And that's what we're talking about here. In a world of 12.4 million accredited investor households in America, you only need to access a couple basis points to have a great business. Yeah. But acquiring them is difficult because it is an inefficient marketplace. And that's kind of one of the things I talk about with other sponsors is they're amazed that I have my cell phone just out there in the world. I have 600 plus investors. And I said, listen, given everything that we do from a reporting standpoint and all the infrastructure we have in place, I don't get phone calls. I mean, every once in a while, sure, but it's taken care of on the front end. But it wasn't always that way, right? I had to take my licks to learn. So
yeah, that's right. And I think that's where this all started, was just saying like, hey, where was the stub toe? Right. And it's those are the things that, I think too, to investors, like, what else can you bring to the table to a young and emerging sponsor, right? Is that if you have a skill set, you're a good communicator, you're organized, whatever, you might actually be able to add more value to them. Because once again, I just harped on it, and I know it because I run the numbers, right? I model these things for guys. It's skinnier than you think. They're not getting rich off of whatever comes in. It's just, they're not, right? The amount of people you need and the diversity of the people you need on your team to pull this off is great. And it's becoming more of a team sport. So it's like understanding that if you can add value there, right? Not to mention that they might be willing to give you a little sliver of the GP or whatever. Like there's opportunity there. But this is how we all work together to sort of continue to mature, this, what I call kind of this middle market real estate ecosystem. So good stuff. So where can people find you? How do they find you?
Thanks for having me on it. We probably went over time, but it was a fun conversation. I'm super active on LinkedIn. That's how we connected. If you just look me up, Brian Adams, Excelsior Capital on LinkedIn, shoot me a message, follow me. I post a lot, and we put a ton of great content on there. And then excelsiorgp.com is the website. If you're interested in investing or learning about the investments, that's probably the best way to get into the queue. And we have a great resources tab where we do blogs and webinars and thought pieces, and we can crush you with information there. So a good way to learn about who we are and what we do.
That's awesome. Well, this was great. Yeah, I did. We went over, but man, it was a really, really productive conversation. Good stuff to touch on. And keep on solving for that double-digit cash return.
I'll try.
That'll keep you busy,
Yeah, we've got a couple things in the hopper. So thanks again, Lance. It was fun.
Yeah, you're welcome. Take care. Thanks.
Okay.